Hello and welcome to the Harwood Report for June 25th, 2018. I'm Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. All right, so obviously the market is having a big move today. These trade war escalation rhetoric is finally really doing some damage to the market. Is it too much today or was it too little last week? That's for the market to tell us now going forward. What I would imagine is that maybe it's a little bit of both, that the market wasn't pricing in enough fear, had to catch up, and now the market has loosened up a little bit. We're not grinding higher. I mean, it looked like last week the market really wanted to go back into 2017 mode and just grind higher, and today it looks like it just kind of wants to loosen up and allow some people to trade as opposed to having to just watch those small returns every day. So let's take a look at some of the stuff I normally look at here. First off, fear and greed is down to 42. It's not a huge change here. Where we're seeing the fear is the market momentum is pulled back to that 125-day moving average that they like to use. I look at some other moving averages. I'll come back to those in a second. Safe haven demand. I'm not really that worried about that. The VIX is showing some fear, obviously. Where we're not really seeing fear is generally in the bond market. So the bond market's not really showing that fear. It just seems to be an equity-focused story, which maybe that's creating an opportunity. We'll see. First things first, obviously S&P's got destroyed today. We broke through this range and basically came all the way back down to the 100-day moving average. This should create some support here because it's generally been support for the last month and a half. But if that breaks, the 200-day moving average isn't that far away. That should create some support. And if that breaks, then we're talking about some bigger moves down to 255 range. So my view at this point is that, the downside here is probably a little more protected. I don't necessarily need to play for a downside move in the short term because the magnitude of that downside move seems like we've got some support here that should slow the market down. Once we break through the 200-day moving average, I'd be a little bit more bearish. But on the upside, the volatility is just a little bit, so pricey that I don't get really good leverage playing for a rally either. It seems like right now the market's best trade is almost just going to be a short put spread, and frankly, that's just not a great leverage trade. I can probably do something a little bit better if I go into one of the other sectors. IWM has been the buy the dip sector. If the market does collapse, this has got a little more downside, 161, maybe even all the way down to 157 in the short term. So we got to watch that. Because that's been where people have been protecting themselves by putting money into small caps, saying that they're less impacted by trade wars. Of course, Qs should be impacted because a lot of this stuff is tech-related, and that has pulled back as well. The support here is pretty close as well, though. Again, it seems to me that the best trade right now in equities is to wait. Volatility is priced well enough that I can't get great leverage trading for the downside. When the downside doesn't seem clear to be a problem, we see the last time the VIX spiked like this, the market just kind of turned around and grinded higher, decided to grind higher, and you can see when that was. That was this breakdown here, where the market just grinds higher for a couple weeks. So if we're going to repeat that kind of thing, obviously today's a much bigger magnitude move than that time, much bigger candle there. But where's the edge? If there's support here, a grind higher is a low leverage trade. And the downside has a lot of support potentially near the market, so I don't think there's a huge trade here in equities. Where there may be a little bit more trade is actually in the volatility landscape of bonds. So we haven't really seen that safe haven demand in bonds. And at the same time, vol in bonds is very cheap. Now, there's not a clear direction to be for bonds, I'll be honest. But at 9% vol, under 9%, this vol is very cheap. Look at that realized volatility in the last 20 days. It's 11.5%. So volatility looks underpriced there for me. And so I stick with what I've been looking at for a while now, and that's just long strangles or straddles. Since we're between the 120.5 and 121 strike, what I look at here is just this simple 120.5, 121 strangle. It's 204. So when I look back at the chart, 204, that would mean I need to get below 118.5 by expiration. It seems like a good consolidation area, 118.5, or above 123. With a strangle, it's just important to scalp the gamut. So when we get a big move, I sell a little bit because right now the technicals on this aren't clear that it's going to be a trending higher, trending lower. It just seems like if the market is going to go into crazy town, the volatility has to increase in bonds as well. So this is more about an increase in either realized or implied volatility. And if the market firms and drifts back higher, then there's not a lot of downside to the volatility here in the bonds because it's near its historical lows. And it's still potential to make some money just off of trading the delta. Let me go over to the metals because that's another spot that I'm not seeing risk off demand. So you see the dollar yen is weak. That's traditionally bullish for gold, and yet today gold is down. It seems like maybe as big of an opportunity as this was, which I had talked about a week and a half ago, this now is becoming another opportunity potentially from the long side. So I went for the short side a couple weeks ago. Now I'm looking at the long side after having this break because I believe that the equity market is going to collapse, and I don't know for sure. But if the equity market collapses, at some point safe haven demand starts coming in, especially if this dollar continues to weaken, especially relative to the yen. So all of this stuff starts to put money flow into commodities. People still like to allocate to commodities when they see that equities aren't the only game in town. And so when equities chop and they increase in volatility, people tend to look for diversification. So gold could be an interesting strategic allocation for people. And if risk off goes in through the markets, then gold could spike. And when I look at gold vol, similar to TLT, it's pretty low. TLT is cheaper. So by no means is this the cheapest vol in the world. I think that honor belongs to TLT right now more than anything. But we can't. I don't see us really getting below 9% in gold, and right now it's at around 9.5%. And so if I'm bullish in gold and think that 9.5% is pretty low, I can still stick with that July term. Don't need to worry about 4th of July next week if I go out a little bit. And I just go for some calls here and look at those 122s for 55 cents. That's a very cheap way to play this. And the call skew there. I don't want to go up too much higher because then I'm starting to pay 10.5, 11 vol. That's a little too high for me. But I don't want to constrain myself when I think that gold could jump up to 123. So I look at the 122 calls and into a rally, depending upon how volatility adjusts, I look for ways to adjust my position. But we could easily be back at 123 in a flash. And that really puts those 122s for 55 at a nice little double, if not more, if it happens in the short term and there's still some extrinsic value. We see a lot of the similar stuff out of silver and the miners. Silver obviously had a bigger washout because it had a bigger break. The big washout because we got right to the bottom of this consolidation area. That creates a little bit more of a problem, I think, for silver just to spike higher. Gold, I think, has a greater chance to do so. And GDXJ has a little bit of an equity component that might hold it back. So in this case, I like sticking with gold in this play. Finally, I'm going to talk to the oils here, and you just noticed that oil is a little bit weak today after a really nice firm day on Friday with OPEC. Let's go to OIH. It's trading near lows. XLE is trading near these recent lows. So the oil pullback is a lot less. We're not trading near the lows of this move. And yet, actually, in OIH, we've gotten hit harder. I think that those are generally going to mean that these are a little bit more bullish. I'll talk more about how I'm going to structure those in the newsletter that I'll be publishing shortly. But just generally speaking, I just want to show you guys where vol is in XLE and OIH. And then if you'd like to hear more about how I'm going to look to structure this type of trade, take a look at the newsletter. And again, I think that XLE and OIH have the benefit of if the market decides to grind higher here, there's probably more it seems like that's a sector that has a need for potential allocation. So if the risk off tone flips and it's back to risk on, why not go into oil after it's already firmed so much relative to where it was when these names were at these lows? So you can see the volatility in OIH is a little bit in the middle of the range. XLE was a little towards the high. So I'll talk about how to structure those trades in the premium Harwood Report. If you sign up now, you get the first 2 weeks for free, and then after that it's $49 a month. It's a pretty good deal for that extra content. I give a Wednesday update, 2 Wednesdays ago, not this past Wednesday, the prior Wednesday, I talked about buying cheap puts in GLD, and I did, and I think that's just one spot where the value can be seen for subscribers. Go to tradeacademy.co/Harwood Report to sign up, or email me, keith@tradeacademy.co. Call me 312-600-8004 with comments or questions. Look forward to seeing you all later. Have a great afternoon.